G'day everyone, welcome to this weekend update for global markets. And the question I pose this week after a couple of fairly heavy down sessions in America is the Christmas rally still coming? My fairly confident answer is yes it is, but there's certainly a lot of nervousness around at the moment. So let's have a look at what happened last week and perhaps how that might unfold over the coming period. So we'll start with the American market. The S&P was down a very sharp 3.5% on the week. That's quite a big fall. That's one of the biggest falls we've had in a week for some time. But I have to say that the market was ripe for some profit taking, and the trigger for that profit taking, there was quite a few of them. There was concerns about Greece calling early elections and what that might mean for their financial markets. Of course, the rout in oil was the main thing, and that's really having an impact in all sorts of unexpected ways. We had less than ideal data out of Europe, and also the ECB is having trouble generating enthusiasm for some of their bond sales, which is not good. And there was also some Chinese data that was less than ideal as well. So all in all, when you've got a market that had charged as hard as it had in America and where prices were significantly overbought, it was absolutely right for some profit taking, and that's exactly what we got. I don't think that changes anything. The fundamentals, certainly amongst the stocks that I trade and the stocks that members of Special Share Education trade and invest in, the fundamentals and the values are still really good. So I don't think it changes anything. Except, we're going through this bit of a nervous period. So for me, the end of year rally is still likely in general terms. So that's at the S&P 500 level, but also it's highly likely in the stocks that we trade within the membership. And that's purely because the earnings are growing at terrific rates, and there's really still good value there despite some fairly substantial price increases. So members of Special Share Education have had a pretty solid year, and I expect 2015 to be something similar. Now, the Australian market was down 116 points on the week, but we're going to lose another 50 to 100 points on Monday, depending on how the market digests what happened over there. Certainly the futures are pointing to about 70 points down at this stage. As I said last week, it's very, very hard to find stocks that are likely to go up, and the few that are generally reasonably fully valued to overvalued. So I'd be avoiding the vast majority of the Australian market and obviously commodity stocks. There's a huge cloud over all commodity stocks, and I really would strongly recommend against trying to pick the bottom in commodity stocks. There are some bargains emerging in the high growth stocks that I think are the best ones on the market, but you've got to be very patient and very selective in how you pick those. Now, just before we move on to commodities, let's just have a look at the global stocks. This is the S&P 500 in late September to mid-October. We got a sharp decline in the market, got down to oversold. The market then just charged straight back up again to new highs, got basically back to 2070 odd, and we're now pulling back, which is, to be expected. So I'm looking initially at a support zone between about where we are now, which is around about the 2000 mark, and around about the 1980 level, picking up these highs back here in June. So between 1980 and 2000 is a possible first support level. We could dip a little bit lower. We could get down around the 950 mark. But if that happens, then it's just an even better buying opportunity than buying if it turns in the next few days. So I'm still very positive on the American market. If you look at the NASDAQ index, the shape of it is very similar. But what's encouraging is that the NASDAQ, which tends to lead the market, has pulled back a lot less than the S&P. So that's a pretty positive sign as well. If we look at the Russell 2000, also too, there's really not been very much of a pullback in the last few days. So they're all pretty positive signs. Just for the record, the Australian market, because it really doesn't properly reflect what's happening in our market. If you factor in the likely fall in the futures, we're going to see the Australian market down around this bottom that we had in the middle of October. So our market really is struggling, and we are down on the year. So the Australian index has made no gain at all for 2014. So not a pretty sight there. Turning to commodities, gold had a pretty good week, despite the fact that the US dollar was still reasonably strong, gained another $30 on the week. It needs to close above 1250 to confirm an uptrend. We're not there yet. There's major support on the underneath side at 1025, so it's still stuck in this overall range, as we'll see from the chart. And the gold stock indices, they broke support, they rallied back to the breakdown level, and then they've turned back down again. So the gold stock's still struggling to gain any sort of traction whatsoever. Let's just have a look at the US dollar, because that's important. It is impacting commodity prices. So if we pull back and take a big picture look, if you pull back and take a really big picture look, you can see that the American dollar has declined from its highs in 2001 and 2002, lengthy decline, and now we've had this big consolidation which really started around about the time of the GFC. So a very big range consolidation, but you can see very important resistance level here at just under 90 on the US dollar index. But you can see in the last few months there's been a very strong rally. Now all the fundamentals would suggest that we're probably going to see a breakout in this dollar index. Just tighten that in a little bit. All the fundamentals would suggest that the US dollar index is going to go higher against all the major currencies. European currency, the euro is going to be weaker, Japanese yen is going to be weaker, and of course the Australian dollar is going to be weaker as well. So I would expect that the US dollar is going to continue higher, which is going to keep pressure on commodity prices. So let's look at the gold price. So this is US dollar gold on a daily basis. So you can see we had a nice move on Tuesday of last week, and it managed to hold it throughout the week. Just panning back and looking at the weekly, you can see we've got a bit of a breakdown from this support zone. We've rallied back into it, so it could just be a false break. And I'd really want to see it move above this little high here, which was the week of the 24th of October. I want to see a move above there before you can start to get remotely excited about gold and gold stocks. Looking at the gold stock indices themselves, this is the GDX index. Quite clearly a significant breakdown, a rally back to that level, but unable to break back into that phase one base. So things not looking all that clever for gold and also for other commodities. And with the US dollar likely to break higher, it's really hard to see how commodity stocks are going to get back into an uptrend. So copper ended up steady at $2.96, but it's just hanging in there. It's broken support and it's just hanging around that support level. It wouldn't take much to tip copper over the edge. Crude oil's been the big story of the last few months, and particularly the last few weeks since the OPEC decision. And it really fell away on Thursday and Friday, got down under $58 on Friday night. So this decision by OPEC is going to have a very significant impact until the middle of 2015, which is when their next scheduled meeting is going to be. So I wouldn't be expecting a quick bounce back in energy stocks. If you try and pick the bottom, you might end up getting burnt. So be very, very careful. There's copper. You can see we got the breakdown from $3, and then since then it's just basically held in a little range between the low 290s and around about the mid 290s. So overall, the strategy approach is the same as I've had for quite some time. The trends in currency make exposure to the US stocks for Australian traders and investors an absolute no-brainer in my view. Members of Special Share Education that have traded in the US have not only made extremely good gains on the stocks, but they've had this terrific currency boost as well. So it's been a double-edged sword. I would be avoiding most of the Australian market. It's very hard to find something that you could feel confident would go up, unless of course you're shorting the market, in which case there are certainly some opportunities. I'd be avoiding commodity stocks and especially the service industries. That's not only mining, it's the energy sector as well. This is not just a cyclical shift in the markets and they're going to bounce back. This is a longer term structural change, so quite significant. That's it for this week. If anyone would like to find out more about what we do in Special Share Education or would like to contact me directly, there's the details, and talk to you next week. Cheers.